Okay, so let's talk about this. This is Salvatore's figure 12.1, and it's a story of international capital transfers. Let me move over here. So we spent a lot of the chapter talking about, or the textbook, talk about movement in goods. So free trade is wonderful, it's win-win. If the other country has a cheaper X, and the other country has a cheaper Y, the one country imports the X, the other imports the Y, and they both attain a higher level of utility or efficiency, and all these good things happen. So free movement in goods is win-win. So that's international trade. But international economics is generally concerned with the movement of three things. Trading goods, we just talked about that. Trading capital, physical plants and equipment, and also third, the movement in people. So this graph talks about the international capital movements, and we can think of a capital abundant country like Japan has a lot of capital. Nation one can be Japan. And then another country, maybe Thailand, that has less capital. So that'll be nation two. Now, and we're going to see, what if Japan, who has so much capital, sort of gives or transfers some of that capital to the capital scarce country, Thailand. We can think of that in many ways, but the easiest way is probably to think of Japan, instead of building that factory, that Toyota factory in Japan, in Kyushu or Hokkaido, they build it, they take that capital and bring it to Thailand and build a factory there. So the capital abundant country is moving some of its capital, investing, foreign direct investment, moving it to another country. We can think about other capital movements, but I think that's the easiest one. So physical capital, plants and equipments, one abundant country, one scarce. What's going to happen if we allow the abundant country to transfer, not give, but move some of that capital into the other country? Okay. We could do a similar figure, and indeed in Salvatore, in the text that this version is from, there's also a story about movement in labor. So if there's a labor abundant country and a labor scarce country, is that movement going to be win-win? Is it going to be good for the country that's losing the labor, and is it going to be good for the country receiving the labor? So you can think of England, I don't know, in the 18th century, or early 19th century with a lot of people, and then Australia with no people except the Aboriginal natives, and then a lot of people go from England to the labor scarce Australia. Is that going to be good, aside from the cultural issues and the Aboriginals? Efficiency wise, is that going to be good to move a lot of people from the abundant country, England, to the labor scarce country, Australia? Of course, we could think of labor abundant Mexico going to America, or whatever story you like. Okay. Now, getting back to the capital representation of this, and this is all standard neoclassical assumptions. So we have MPK, marginal product of capital, for nation one measured on this axis, and for nation two measured on this axis. And we see that the slopes are downward sloping. So this happens if we have diminishing returns to capital, and of course diminishing returns to labor. So if you've had a lot of microeconomics, you should know what diminishing returns means. But let's just review. Basically it says the first initial outlay of capital will have a very high return. Let's think of Japan. So Japan has land and people, and then they start putting capital on it. Japan accumulated a lot of capital in the 20th century, especially in the latter half of the 20th century. So Japan's accumulating all this capital, putting this capital to work. It's making more output. Okay. But by the time we get to the 1990s, Japan has a lot of capital per worker and a lot of capital per land. What if Japan puts even more of its capital together with the Japanese workers? Will that increase output? Yes, probably, but probably less than the initial capital. When the workers had no capital and they got a machine, that increased their productivity and output a lot. You keep giving them more and more machines, it increases their output, but at a diminishing rate. Right? So the example I often give is agriculture. Japanese agriculture is highly mechanized, highly capitalized. They're using the latest tractors and technology. So the one worker, the one farmer in Japan already has a lot of capital. Maybe, I have no idea, but let's say that that worker has $300,000 worth of capital in little tractors and plows and harvesters and maybe fertilizer, we can call that capital. So they have a lot of capital per one farmer in Japan. That makes that Japanese farmer very productive. If we think of a farmer in Thailand, of course there must be some highly mechanized farming in Thailand, but maybe on average the Thai farmer has maybe $1,000 worth of capital per farmer. Okay, so if you give another $1,000 worth of capital to the Japanese farmer who already has $300,000 worth of capital, it might make him a little more productive. Maybe he gets a new add-on to make his tractor run faster, a little bit smoother, get better sort of gas mileage. But if you take that $1,000 of new capital and give it to the Thai farmer who only has $1,000 worth of capital, that $1,000 of new capital will probably, as we say in America, have a larger bang for the buck, or it'll have a larger increase at the margin for that Thai farmer. Basically, the $1,000 is going to do more good in Thailand than in Japan because the Thai farmer has less to start with. Okay, so that doesn't have to be true, but that's what we're saying if we believe that diminishing returns is going on. So that's what we assume here. So that's why these VMPK for nation 1 is downward sloping. If you add more and more capital, this is the total amount of capital measured on the horizontal axis. You can't see it down here, but it says total capital of 1 and 2. I don't want to touch my iPad because it's in a sort of fragile, semi-stable situation. I don't want to knock it over. But this length is measuring the total capital of, let's say, nation 1, Japan, and of nation 2, Thailand. Okay, so as Japan dumps more and more capital into production, they're going to make more stuff, and I'll explain that in a second, but at a diminishing rate. Okay, let's talk a little bit more about that. But let's talk about the horizontal axis. Okay, so we have this 0 to 0 prime, and that's going to be the total amount of capital in nation 1, nation 2. So let's assume that there's only 2 countries in the world, and there's, I don't know, let's say there's $500 billion of capital in this world of 2 countries, nation 1, nation 2, or Japan and Thailand. But let's say that most of the capital is in Japan, which makes sense. So let's say this 0 to A is 400 billion, and let's say this the remainder of the capital in our world is in Thailand, and that's from A to O prime. So we have 400 billion here and 100 billion here. It's not exactly to scale, but forgive me on that. So of the total capital stock in our world, there's 500 billion. A lot of it's in Japan, and not as much as in Thailand. Now, a couple things, we'll be able to observe a few things in this situation. Now, where capital is very abundant in Japan, capital is going to be very cheap. That's supply and demand, and that works here too. So what is the price of, or the value of capital? Well, if there's a lot of capital, it's going to be very cheap. And if our markets are working efficiently, then the value of the marginal product of $1 more of capital should be the price of capital. So this is actually the price of capital. So we see that if most of the capital is in Japan, they use a lot of it, and each additional unit of capital doesn't add a lot to additional output, and that's going to be the value of the price of capital. So the C here, or 0 to C, is actually the value of the marginal product of capital, but it's the price of capital in Japan. They have so much capital. The extra capital doesn't add a lot to the workers' productivity and total output, and so the price is cheaper for capital in Japan or nation 1. Now, if we go over to nation 2 or Thailand, they don't have a lot of capital, okay? And so the price is scarce, and so H is the VMPK for nation 2, and that'll be H. So H is higher than C, which is to say the price of capital in Thailand is very high and the price of capital in Japan is very low. Capital is scarce in Thailand. It's hard to get capital. You have to pay more to get the capital because it is scarce. Okay, again, supply and demand, but in the capital market. Okay. Now we see that things are going to change. But initially, in the capital abundant country, capital is going to be cheap. Here, capital is going to be scarce, high. Okay, so if these were goods, this would be price X was cheap in the one country and price of X was expensive in the other country, so we'd buy the cheaper X in the other country. Here, we have to think of yourself as a firm owning the capital, and the price of capital is also the return on capital, the marginal product. So if Japan puts that $1 extra in Japan, that $1 extra of capital in Japan, the value is C. But if they put $1 extra in Thailand, the value is H. Thailand needs the capital. They want the capital. They're willing to pay more for the capital. Or you can think of it in sort of physical output terms. If that Toyota factory puts the extra $1 million worth of investment in Japan, they'll get some return. But if they take $1 million and put it in capital scarce Thailand, they'll get a much higher return. They'll get a return of H. So why not invest in Thailand rather than Japan? Now, of course, investing in another country has risk and political risk, and they speak different languages. Infrastructure is better in Japan. So there's a lot of other things that stop this from happening, right? So even though the return should be much higher, there's a lot of reasons why it doesn't happen as much as it should, but it does happen, right? Capital abundant countries do invest in capital scarce countries. Okay, one more piece of the puzzle before we start moving things around. We have this black line, the VMPK for Japan or Nation 1, and everything under that area of that, we call it a curve, it's a straight line, but everything under the area of the curve is actually the total value of output. So if you put a little bit of capital, you get a very high return, and this is the value of the stuff you make. If you keep on adding capital, you'll make more stuff, and this area gets bigger and bigger, but at a diminishing rate. Okay, so the sort of the takeaway or the main point of that, just to repeat, is everything under the area of this curve up and to the point of the capital is the value of total output for Nation 1. Okay, so that's, oh, I don't have that one labeled. Okay, so 0FGA, that shape, that area, is going to be total output, value of total output in Japan. To start, we're going to do it before, after. This is the initial situation. And in Thailand, it's going to be AMJO prime, this area here. So they have a little bit of capital and a high return on it, but they're not making a lot because they don't have a lot of capital. So this area is going to be the total value of the output in Thailand, or by Thailand. Okay, so we have here, we have here. This is the amount of capital in Japan. This is the amount of capital in Thailand. Okay, great. Now let's let the capital flow freely. Okay, so the capital will flow where the return is higher. The return is higher in Thailand, or Nation 2. Maybe these little arrows help. So instead of Japan putting, I said 400 billion here, they're going to take maybe 50 billion of it and take it out of Japan and put it in Thailand. So we're transferring. We're taking that $50 billion, let's call that $50 billion, out of Japan, or instead of Japan, and putting it in Thailand. So that means there's less capital in Japan. So now capital in Japan is 0B, and there's more in Thailand. So instead of A to 0 prime, there's B to 0 prime. So we've transferred from here to here. Okay. All right. So think about that. Let it sink in. Let me get out of the way. Okay, so what's going to happen? Well, let's look at the new value of output for Japan. Now, Japan has taken some of the capital out of Japan and put it into Thailand. So it should be that Japan's total output decreases. And indeed it will in this figure. So before, Japan's total output, or value of the total output, is here. Then it falls to here. So total output in Japan falls by this amount. We could think of it as GDP. In Thailand, before, the total output was this amount. They get more capital. Now they can produce more stuff. Now Toyotas are being made, some of the Toyotas, in Thailand and not in Japan. So now the output increases to BEJO prime, this larger area. So the gain in output in Thailand is this BEMA, this area there. So there's a loss in output in Japan, this area. There's a gain in output in Thailand, this area. So when you put the two together, total world output goes up. World meaning nation 1 and nation 2. Okay, hope you can see that. So total world output goes up by EMG. Great, more productive. Just let things go where they have the highest return, and that's the efficient thing, and efficiency means greater output for the same amount of inputs. We haven't increased the amount of capital, we just moved it around. Right? That's what is supposed to happen in all markets. That's why markets fail sometimes, but the basic principle is that the price will draw capital to where it's most needed. And they need a lot more capital in Thailand, there's a higher price, and the firms will say, well, I'll get a higher return in Thailand than in Japan, so that's where I'm going to invest it. And so there's the gain. So great. Free trade in international capital is efficient. Efficient meaning total world output has gone up. But then let's break it down into the gains for nation 1 and the gains for nation 2. So let me just carefully read this in Salvatore so I don't mess it up. EGR. Now, of these gains, some is shared by Japan and some is shared by Thailand. So this EGR is the gains to nation 1, Japan, and this EMR is the gains to nation 2. Okay, so it's win-win. Okay, so surprise, surprise, allowing the market to flow freely to the high price is going to be the efficient outcome. Okay. Again, we're ignoring cultural impact or political impact or anything else. Just the pure efficiency of the economic movement would be the following. Now, we can do a few more things to sort of break down the gains from this. The one thing that Salvatore discusses in the little shorter description, but at length in the chapter there, so I'm just doing this part here, is that I'll just read it off, but right, so of the increase in the total domestic product of ABEM in nation 2, so ABEM in country 2, that's our Thailand, total output has gone up, so that's GDP, but then how much of it, ultimately this is a foreign firm investing in nation 2 or Thailand, and the investors want a return. They're going to take a return on that capital. It's going to create jobs in Thailand. It's going to create output in Thailand, but it's also, they're going to get paid that return. Originally it was H, but then it declines on that capital. So how much of this new output goes to Japan and how much stays in Thailand? And the answer is this amount, the bigger amount, ERAB goes to Japan, and this amount of the increased output, value of the output, stays in Thailand. So you could say, okay, well, Japan benefits more than Thailand, but the larger lesson is that they both benefit. Thailand benefits from Japan deciding to put some of its capital in Thailand rather than Japan, and the Japanese firm also benefits by putting its capital where it gets a higher return. And overall, Japan the workers in the capital and the overall welfare will benefit, and overall the overall Thai economy will also benefit. Okay, so it'll be a net welfare increase, or a win-win for both countries if we add up all the welfare movements and changes when this goes on. Okay, so this has a lot of the story here, but there's other ways we could show the other changes in welfare, the welfare effects of capital movement. So there you go. For this figure, I want you to focus on, that's a lot. This total world output gain, the gains to the one country, the gains to the other country, and if you like, the gains to the Japanese investors or Nation 1 investors, and this is the gains of that new production that stays in 2. Right, this is net gains, right? Because Japan lost because they're not producing Toyotas as much in Japan, so there's a loss there, but then the Toyota gets this big gain. So the net gain for Nation 1 is that triangle. Okay, so again, there's a few things, players or actors here winning and losing. One thing I forgot to mention, but maybe it's somewhat obvious. This is the new point. Okay, so what happens to the price of capital in Japan? Well, it goes up because there's less capital. Now it becomes a little more scarce, so it goes up. And then the price, there's more capital coming into Thailand, so Thailand's price of capital goes down, of course, diminishing marginal return to capital. What is that, N and T? Yeah, it's N and T. N and T are the same. That's going to be the new price. Okay. It's going to be the price of capital in Japan. It's going to be also the price of capital in Thailand. So it's going to be one price, right? If we allow things to freely move, if there's a price differential originally, then it'll equalize, right? Just like anything. Like if the price of gold is cheaper in South Africa and more expensive in London, then everyone in London is going to buy the South African gold and ship it back to England and sell it for a higher price. And as they keep on buying the gold in the cheap gold in South Africa, the price of South African gold will go up. And as they sell that gold back in London, where they can get a high price, it's going to bring the price down for gold in London. And eventually, if we have free movement in gold, as we do in the global economy, there'll be one price. So same with capital. If there's free mobility of capital, there'll be one sort of global price of capital. And in a sense, we could argue that international capital markets are very open for most countries. There are barriers and things, but firms have a way of investing where they want to invest. So you might think that the return of capital is actually quite similar across countries. Perhaps, perhaps not. And then the other thing that's we always have to think about, the return on capital. This is a real economic return just based on production functions and diminishing returns. But the reality is Japan is a very safe country, and Thailand is a relatively safe country, but it has, 8 years ago or whatever, it had a coup d'etat, it has martial law, it scared away a lot of investors. Thailand has not nationalized Toyota or foreign firms, but they could. So there's a risk there. So there's an investor risk that's going to make the potential return of investing in a country like Thailand lower, right? Japan, you'll get a lower real rate, but you won't. There's less chance you'll lose your money. But in here, you might get a higher return physically, but then you might lose it all. So we have to risk adjust that investment. So in reality, returns are not the same across countries. But in theory, if both countries were peaceful and stable and had the same infrastructure, then capital would go where it's most needed, and we'd have one price. And so the last thing is, we're not going to do the immigration story here, but this, instead of K, we could have L, and then it would be the exact same story. But this would be wages. This would be low wage country. This is a labor abundant Europe, and this is a labor scarce Australia in the 18th century or something. And if all the people from Europe go to Australia, then it will equalize. Right? That's also why you can get a really high paying job in digging oil out of oil sands in the remote parts of northern Canada, or mining industries in remote parts of Australia. Right? The wages are high because no one's there. So if you want to go there, then you're going to get a really high paying job living out in the middle of nowhere, and you can save your money and go back and be a rich man or woman. So same story. But if everyone goes out to the labor scarce place to get the high money, then the wages will come down, and the incentive to go there will of course decline. Okay, so let me stop the video there, and eventually I'll make a Japanese version of this, but let's start with this. Thanks for listening.